Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host today and every day. And we're calling this episode Potpourri. Potpourri is the term they used to use on Jeopardy to be a category that included lots of different stuff and little bits and pieces that could be sort of anything. And that's kind of today's podcast. You know, I've written commentaries. I've written market commentary for a long time, many, many years, going back to the 90s. And there's always been a really interesting phenomenon that the more I wrote, the easier it was. When I was writing a daily comment, it's a lot of work to write a daily article, but at some level, it's somewhat easier because you're telling a story, and every day you're kind of advancing the story. You're telling what changed. You're telling what people should look for, and occasionally you can do a little side, something a little bit on the side. A little side story, but you're telling the same narrative. As I got older and I got busier and I would do commentaries less frequently, and you can see this on my blog. When I first launched my blog back in 2009 or whatever it was, inflationguy.blog, I put something out every day. And it was general market stuff, and now I'm more, purely inflation focused, obviously, and so there isn't necessarily something to talk about every day, but that actually got harder. I would put out an article every few days, or every week, or every 2 weeks, and the longer I went, the harder it got to write another article. And the same, as it happens, is turning out to be true with this podcast. That every month I do the CPI summary. And that's sort of easy. I know what I'm going to say. I've already written. And then I want to do at least one or two other podcasts that month, but it's a little bit difficult. There are, because I'm not doing it every day, as some podcasters do, because I don't have it's not like a true crime podcast where I'm advancing a particular narrative every day or every week. It's harder. And so, when you sit down and like I did this week and I said, look, I need to put out a podcast. I need to put one in the can and put it out there. What am I going to talk about? And the problem is that there are lots of little things to talk about, but it's hard to come up regularly with a whole episode. Anyway, that's how we got to Potpourri. There's a couple of different things that I want to talk about today. And we're going to start with monetary velocity. And obviously, this is something that I have spoken a lot about before, and I've made some predictions about. And we just got the third quarter GDP numbers, and so I want to sort of give an update. When they report GDP, that's when we finally have enough information to know what money velocity has done, because we calculate money velocity as sort of the leftover figure in the monetarist equation of MV equals PQ. And we know we can look at what money supply did for the quarter, and we know what, when we get P and Q, the GDP price index, and Q is the GDP growth figure itself, then that gives us 3 out of 4, and we calculate velocity. We don't directly observe monetary velocity. And so today we got the GDP figure, which means we can calculate M2 velocity for the third quarter. And it was up 1.84% quarter on quarter, or roughly 7.25% annualized rate. That's quite a large movement higher in velocity. It doesn't look necessarily like it because we had such a massive decline in the COVID crisis, but it's a big jump. Actually, the 5% year on year compared to the third quarter of 2019. Monetary velocity is that 5% rise is the biggest increase since 1995. Monetary velocity has been declining steadily for a very long time, along with interest rates. and so we've known for a while that velocity had to be going back up, and I've said that on this podcast. Just by definition, it has to go up unless there's something weird that's permanently impaired it. We've had M2 deflated by GDP, so M over Q has risen about 30%, depending on when you measure it from, so far in the few years since COVID started, and prices are up about 15%. So that difference, 15%, represents the decline in velocity that happened all of a sudden when suddenly the Fed started flushing a bunch of money in. That difference has to be made up one way or another. Unless velocity is permanently impaired and money is just going to turn over more slowly forever, then eventually, and by the way, this has been true for more than 100 years in hundreds of countries, eventually M2 divided by GDP tells you where the price level is. And so when you have a big difference like we have now opening up, eventually that has to close. Now, what drives down money velocity over time is, and in a short period of time, is interest rates and in general sort of the opportunity cost of holding cash. When interest rates, longer-term interest rates go up, when the stock market goes down, and so there's an opportunity cost to holding cash, then people tend to hold smaller cash balances, which means more money velocity, and I guess sort of the flip side, when interest rates go down, we tend to have lower money velocity, but also people tend to hold more cash when they're nervous and when things have, when they have a great deal of uncertainty. And so that's a precautionary demand for real cash balances. And so that also tends to decrease velocity, but it tends to not be permanent. And there's a third thing, which I've never really thought about, never really included until this crisis, and that is that you can be holding cash because so much of it was squirted into your bank account that you just don't have, you're not ready to spend it yet, and that's what happened over the COVID crisis, and so it's a little bit like, and this is sort of unique. We've really never seen this happen in velocity, but it's kind of like monetary velocity in this cycle has acted like a pressure vessel. That when money supply spiked and GDP didn't, and prices started to go up, but prices didn't spike overnight, mathematically, that has to go into a velocity. And so velocity acts like a pressure vessel. It suddenly declined, and part of it was this precautionary demand for money, but part of it too was in an unintentional holding of cash balances. And like a pressure vessel, so it takes that pressure initially, but gradually now releases it over time. And that's what we're seeing. Now money velocity is starting to go back up. And what that means is for a given level of money supply growth, right now money supply over the last 6 months has been flat, even down a little bit, M2 money supply, which is weird, and I'm not totally sure. I think that's going to persist in the long run, but it has so far. But you'd say 0% money growth, we should be having, deflation, except you have this pressure vessel, money velocity, that has to go and recover. It has to restore this extra 15% to the price level before we're done. And so it's going to add increments to what otherwise would be the equilibrium going forward. And so that's what's happening now, and we're starting to see money velocity rise back up. So that's velocity, and that's what I wanted to say about that. Housing. I tweeted. I'm getting ready to just get totally can free Twitter and maybe just have just talk to the people who pay for a subscription, because the amount of just garbage that happens on Twitter when you tweet something that's valuable and you're giving it away for free, and you just get all the trolls, and it's very disheartening, and takes a tremendous amount of time to respond to the trolls and cancel them, block them, whatever. So I tweeted the fact a very simple chart from Bloomberg showing that the money supply, M2 money supply, is up about 40% over this crisis, and so are home prices, measured by the Case-Shiller 10-city home price index. And it's very obvious that when the money supply started to accelerate with a short lag, so did home prices. It's crystal clear on the chart. And my observation was that everyone says there's a bubble in housing and we're going to have a housing crash. I don't see it. You can argue that home prices might be a little bit higher than they should be for to wages and whatever, but wages are coming back up, so you could solve it that way. But they really don't look terribly extended in real space, particularly when you look at what's happened to the quantity of money. Look, folks, if you have twice as much money out there as you did before, and I'm just using that because it's a round number, if you double the amount of money out there, but you don't double the amount of real stuff, then the amount of money that you have to give for that same real stuff should double. The price of that real stuff should double. And so you'd expect to see, all else being equal, the value of real stuff going up with the tide of money. That's not at all unexpected. And in fact, that's exactly what we've seen in residential housing. Well, people totally lost their minds. And first of all, it's terrible. It's really fascinating how many people desperately want the housing market to collapse. I don't understand why they want it to collapse. I kind of think there's something of a political thing going on. And, if you don't like Joe Biden, and I'm not a fan, but if you maybe your vision gets obscured and you just want everything bad to happen, because so many bad things are happening and so many of them are his fault, but you just want everything bad to happen. That's one thing I can think of. I can't imagine why you'd want the housing market to collapse. It seems like that should be a place where, either there's a bias to wanting it to go up, since, net we're owners of houses, or you can be more objective. But certainly I wouldn't think that people would want – I can't think of who has the interest to want housing prices to collapse. But at least you should be able to objectively look at the data. And I simply had a chart very clearly showing this relationship. And one of the reactions was, well, I started the chart in 2011. They said, well, why did you start that chart in 2004? Because you could see that, in the last, in 2007, 8, 9, 10, that home prices didn't, track with money, which of course is like kind of my point. In 2007, there clearly was a bubble. And one of the ways that you knew there was a housing bubble was that housing prices went up far more than the money supply. Their value in terms of the value of the housing stock in terms of the proportion of money that it took, if you want to think about it that way, was much higher. And so, I mean, it was an evident bubble at the time to everybody except Ben Bernanke. But it absolutely showed up in the fact that home prices diverged from the amount of money being created. That's not at all what's happening here. And so my exact point was, this is not the same as the housing crisis. We are not going to have a collapse in home prices the way we did the last time around. Things are very, very different. Now, home prices may decline in real terms, right? We've got the price level going up 5, 6, 7, 8% a year. So it wouldn't be terribly shocking if home prices only went up 2% a year, and so they declined in real space. But it's hard when the price level is jumping that much to have the price of a real asset go down in nominal terms. And that was sort of my point, that, look, if you look to the 1970s, housing, residential housing never went up less than 3% a year, even though mortgage rates skyrocketed. And so rising mortgage rates should impact activity in the housing market. It should affect Q, the quantity of the transactions, but there's no reason it should affect the price of those transactions. Except, I try to be objective. And so I can think of ways that we can get the nominal price of houses, of the housing indices anyway, to go down. So because, if you're a homeowner, and in the United States, most of our mortgages are fixed rate mortgages. This is not true if you're in Europe, if you're in Canada, if you're in Australia. Most of those mortgages are floating rate mortgages. In the United States, most of our mortgages are fixed rate mortgages, which means that if you're sitting in a home right now, it's gone up in value, but also you're sitting on a 3% mortgage. Now mortgages are 7%. So if you sell your home and you move into another home, you've got to swap out your 3% mortgage for a 7%. You can't carry it with you, which means you're taking a big loss to go and do that. Well, that's going to totally impair volumes. Mortgage origination is going to be way down. The number of people selling their homes voluntarily to move into another home is going to be way, way down because they have to take a financial hit in order to do it. And so it's not at all surprising that you see higher mortgage rates associated with lower activity. But you also are going to introduce a bias. And this is the part that I had to think hard about. You're going to introduce a bias in the price indices, the resale indices, because think of who it is that is going to be selling now. The people who are going to be selling houses now fall into one of two categories. Either they're forced sellers, three categories. One is that they're selling a home and they're going to go rent. A fairly small category of people. The second category is forced sellers, someone who has died and the estate has to sell the home. Divorce and they have to sell the home. They're moving. Their job is taking them somewhere else. They have to sell the home and move. Okay, those are people who, have to, for one reason or another, eat the loss on the mortgage that they're giving up this low rate mortgage to get a higher rate mortgage, and so those are forced sellers, and so we would expect, all else being equal, if somebody is kind of being forced to go and sell their home, it's going to be at a lower price. That person is that we just made it a buyer's market if the only people who are selling are forced sellers. And second, and the other group is investors whose debt isn't tied directly to the property. As a homeowner, if you sell the home, you have to, cover the mortgage. But if you're Zillow Homes or, any of these places that accumulate homes, your debt you take out debt separately. It's not tied to the specific collateral. And so when you sell the home, you don't have to cover the mortgage. Those people they're going to sell just as many homes. There's no reason that their turnover should change. And those are exactly the companies that, as their general debt burden goes up, and as home activity goes down, they may have to shrink their portfolios. And again, they're not exactly forced sellers, but they're more eager sellers. And so it may be that property indices are going to become more biased because they're going to be more of those indices are going to be measured by stressed prices. Again, forced sellers, the eager buyers are only the first-time home buyers. You're not going to have people who are selling their 3% mortgage, their home funded by a 3% mortgage, and go eagerly take out a 7.5% mortgage to get another home, and pay lots more for it because they're also paying a lot more for the mortgage. So the home price indices could decline in nominal terms a little bit. I really don't think that's a very big. It's not going to be a huge effect, and with prices in the general economy going up 5 to 8% a year, it's holding a price unchanged for a year is decreasing at 5 to 8% in real terms. So I don't know that that's going to be a big effect. But the other thing is it isn't real in the sense that it's not measuring the average price of an owned home that doesn't turn over, which of course we don't really have a good way to measure that period. But just something to keep in mind is that okay, so I'll concede there may be some artificial downward pressure on these indices in nominal space. I don't think it's going to be very much as long as we have inflation going up as high as it is. And by the way, while we're talking about housing, there's something else that, again, some people just really want to talk about the collapsing housing market. And one of the reasons that I wouldn't expect home prices generally to do anything like they did in 2008, 9, 10 is that the inventory of new homes and existing homes is just much, much lower than it was back then. Back in 2007, there was a tremendous amount of overbuilding, and you can just look at the number of new homes on the market available for sale was just off the charts. And it's not. It's totally the opposite. We have, near record lows in the amount of new homes out there. But you may not see that depending on where you get your data, because this is, I don't really understand what the historical reason for this is. But if you're looking at inventories of homes, they like to show this in terms of months of new homes. So rather than tell you there's 1 million units for sale, they'll take that number of units and divide by the pace of selling of homes. And it's, I guess, the idea is that's how many months it would take to clear that inventory. So if you're a manufacturer and you've got 10,000 widgets and you're selling 4,000 widgets a month, and it's 2.5 months to clear the inventory. That's how many months of inventory you have. Okay, that kind of makes some sense. Except that the denominator here is crazy volatile. And the numerator isn't. And furthermore, it's the numerator that affects the price. So the numerator is the number of new homes, or the number of homes out there. And the denominator is the months of sales. And so when we have the circumstance right now that the months of sales has fallen off a cliff, well, the inventory of homes hasn't changed, but suddenly it looks like there's enormous amounts of inventory. If you have the pace of sales, and you double the months of inventory, but that's kind of nonsense. It doesn't have any relationship to prices. You care about the number of homes compared to, say, the number of people in the country. I mean, how many roofs compared to how many heads? How often homes are selling, that shouldn't really tell you anything. I mean, again, maybe if you're a mortgage broker, that's a useful thing to look at, and maybe that's where the history comes from. But in terms of figuring out whether or not there's a shortage of homes for sale, and so that should affect prices, you shouldn't really care about the months of sales. You should care about the total number of units. And in terms of total number of units, there's a great paucity of homes for sale. And by the way, we've just added a couple million new heads into the country over the last couple of years. And maybe they don't make as much money as other people, but they're still heads you got to put a roof over. So it does affect demand. Okay, so last point here in the potpourri is the Fed. So the Fed's meeting in a couple of days here, and we've just seen Canada tighten 50 basis points when people were expecting 75. Australia surprised by tightening 25 basis points less than was expected. And I think it's widely expected the Federal Reserve is going to tighten 75 basis points. And I think that's pretty much baked in the cake. In fact, I think I said that after the CPI report it was a bad CPI report, and that people had been thinking maybe the Fed does 50. No, that bakes 75 into the cake. That's what we're going to get. But I do think that after that, we're going to decelerate to 50 and 25, not because the inflation pressures are lessening, because in a very real sense, they're kind of not in some important ways. But there is something to be said for the notion that, you have once you've gone out with your flamethrower and you've just been burning for 20 minutes, sometimes you have to turn off the flamethrower and see how bad the damage is that you've done. And the Fed, when they get interest rates up to close to 5%, it's a little prudent to sort of stop and say, okay, money supply growth is at zero. The balance sheet's starting to, decline a little bit. We've raised rates to, 500 bips. So, maybe we should stop and just see what happens from here. And I think that's prudent. Some people want the Fed to just keep raising rates until it gets above inflation. Okay, that's the Taylor rule. That's what kind of the way we used to do things. And if inflation was moving slowly, that might make some sense. But everything's moving very, very quickly right now, and I think that it would make sense for the central bank to just sort of pause and look around and see what happens. Now, I don't think that means that they're going to turn around and then once we get a recession, as we're going to get, that they're going to suddenly start easing again. I really don't think that's going to happen. I think that at the end of the day, the Fed is going to get a lot of criticism and should get a lot of criticism for a lot of the things they screwed up. But if the net result of this tightening cycle is that interest rates go back to being something around equilibrium, something like 5% as a medium-term note rate, where that represents 2.5% inflation and 2 to 2.5% expected growth, so you get something around a 5% nominal rate, 4.5% to 5% in the long run, and then they stop. I think that's actually that part they'll deserve some kudos for. There's a lot of political pressures though, and so I don't. We'll have to wait and see whether that really happens or whether the 5% just becomes a ceiling that they never want to go above. But I do think they don't really want to go back to zero again. So we will see. I think bottom line is I think the Fed goes 75, 50, 25, and maybe they do another 25, or maybe they do two 50s instead of a 50 and a 25, but then they stop and take a look around in the early part of next year. So that's my guess. I think that was my guess after CPI, and that remains my guess, and I just wanted to put it out there. And that is all of our potpourri for today. And hey, I just want to throw one thing in here really quick before I wrap up and you hear the music, and that is that if you like this podcast, please spread it around. We had a lot of growth early on, and we've kind of leveled out a little bit. And I want to talk to more and more people and have more and more people listening. So if you like the podcast and you like what we're doing here, please tell your friends. I think the next time I talk to you will probably be after the CPI report, but we're coming up on Thanksgiving in this next month, and so maybe I'll squeeze another podcast in there somewhere. If you've got a topic that you would like to see addressed on the podcast, please send me an email. You can contact me, inflationguy@enduringinvestments.com, or you can follow the blog, inflationguy.blog. I'm still on Twitter right now, @inflation_guy. Don't know how long that's going to be. Visit the Enduring Investments website if you have any interest in investing in this area and want to know how that you should be proceeding to defend your money. Because if inflation is coming for you, remember, you know a guy.